Welcome. Today what we are going to do is we are going to look at how investors can market time hot stocks and hot indexes when you've already seen ideas or instruments that have been rallying and you're trying to find your way into these stocks or indexes. The last thing you want to do is chase a high profile, high momentum stock and be caught up in a sell-off. In other words, you don't want to be the last fool in the stock. One of the best ways to time your entry into a stock is to use from a breakout perspective, a momentum timing perspective, and from a swing trading kind of an approach is you always wait for the stock to make to finish rallying. In other words, the stock will be rallying day one, on day two, and somewhere it's gonna have from a daily perspective on a daily chart, it's gonna come to a new closing high. More than likely it should be a 52-week high on a daily, and then a 52-week weekly closing high on a weekly chart. So the stock comes and takes a pause. Now this becomes your day one, day number one, or your week number one when you're counting your base. So this is your week number one or day number one, and what you want to do is you want to have at least 2 days of rest. So a rest day here and a rest day here, and by that I mean you want the stock not to close above this closing high. So you want at least 2 days of rest at least before you get a breakout. Now if the stock breaks out and that's why we are caught on the 4th day or on the 4th week on a weekly chart, then this becomes a legitimate mathematical breakout, and you want to buy the stock just about here when it makes a new approach above and cracks this resistance as shown by the blue line. You want to buy the stock there. Now this is what we are calling the shortest bullish base formation possible, and it is designed for pure momentum stocks. So now if the stock breaks out, say on the 3rd day, this being day one, this being considered day two, if it breaks out on day 3, then this is not, I repeat, this is not a legitimate breakout. What it is actually a continuation of the previous rally, and typically you don't want to follow stocks like that because you might be caught up just at the wrong time and the stock might turn around. What I'm going to do as a continuation of this short video, I'm going to show you some examples of daily charts where the stock took off minimum on the 4th day, on day 4, or on week number 4 minimum. These are usually the best way to get your entry, either with new money into a high profile stock without being caught up by turnaround stories. This, folks, is an original Muadh.com concept, and it just shows you how to get your way back into the stock. Be on the lookout for examples. Once again, this is Eric Muadh with Muadh.com, wishing you all the best.